Commercial real estate has been slammed over the last 2 years. It has been struggling in every single asset class. We're talking multifamily, self-storage, mobile home parks, you're talking retail, all of it. This has been caused for a few reasons, but the trigger was interest rates. Now, lots of times we can think that is the actual cause, but it may not be completely. But here's the thing, it's not over. In fact, a lot of people are saying that it's the bottom, or maybe that we're out of it, where we might not be there yet. In fact, it could get worse. And if it does, it will most certainly be through the end of this year. And I'm going to show you why. Now, not only are we going to go over the contraction, as some people are calling it the crash, all the pain, but why it hasn't gotten to the bottom yet. In fact, it is being dragged on. We haven't actually felt most of the pain associated with this contraction in the commercial real estate sector. Does that mean, though, that you should not invest or that you should be investing? At the end of the day, that's the question. Are we trying to time the bottom, the top? And what do we do in situations like this? And I'm going to tell you, this is the same thing that we saw through 2008 when I was investing, and as well as slowdowns after 2018, COVID, and what we saw in the transition of interest rates going up. It can be confusing, scary, and it leaves the market with so many unknowns that it freezes. But that's actually where the opportunity is. How do you take advantage of the opportunity without getting burned? I'm going to tell you. First, the development freefall. And when I say freefall, I mean freefall. We're talking about a drop of 40% since 2019 in development starts. That is a massive contraction. And two, this is the important part. Development contractions aren't quick. In fact, they are lagging. These are massive lagging indicators, and they almost always end up being signals to buy or sell. And what I mean by that is, think about if you're developing, especially in commercial real estate. You've got to get your approvals. You have to buy the land. You've got to do plan design. You've got to go and do your underwriting, your analysis. You got to work with builders, contractors. This is not something that's easy. This takes a long time. In fact, years. That means that when development start to drop off, it is years after the pain already started. Because projects were already started and funded, even when higher interest rates went up and markets contracted, it took them years later to actually get out of the ground. It had already gone. They can't just not do it. This creates a tail on this development cycle, and this tail can be really long sometimes. But it's on the back of a development boom. Now, why was there a development boom? A lot of people think that there was a development boom due to demand, and that is correct. But it's not the good demand, it's the bad demand. Now, what's the bad demand? I'm going to put it simply like this. You have two sides of value. You have intrinsic and extrinsic. Intrinsic is simply what the asset makes you. You buy it for $1 million, it makes $100,000. Your intrinsic value of that is that $100,000, whatever it produces. Extrinsic is what you can sell it on the market. So it may produce $100,000, but when markets are up and capital is really cheap, that could be worth $2 million. But when interest rates go up, capital's not cheap and there's no more buying, that may make it $1 million. That's extrinsic. It's the price on the market. What developers were able to do were they would build a project, and when that project got to CO, or certificate of occupancy, they would put it on the market and sell it as if it was full, on pro forma, like it was a stabilized deal. And at the time, because money was so cheap, the cap rates were really low, meaning they were building it for $3 million, and then they were selling it for $8 million. They were making a ton of money, yet they didn't have to do any of the work. They didn't have to fill it up. They didn't have to operate it. All of that risk got transferred to the buyer, and people were doing this. And they did it a lot. That meant developers developed more. Why? Because it was a money printing machine. And developers develop when they're given money. That's it. And banks gave them money. And so they develop. When interest rates went up, what happened? First, the ability for that asset to pay the debt became much harder. That meant there were less buyers at certain valuations because they literally couldn't pay the debt with the income it produced because interest rates went up so high. That also meant that it was risky. Now, when you have such big debt loads and when that affects cap rates, meaning that cap rates go up, that means values go down in commercial real estate. Cap rate is an expression of value, nothing else. If you have $1 million property and it makes you $100,000, not without debt, not including debt, that's a 10 cap, a 10% return. That's the easy way to look at it. If a cap rate goes up, meaning that a 5 cap would make that same $100,000 property worth $2 million, goes to a 10 cap, it makes it $1 million. 5 cap versus a 10 cap is half the value. So in commercial real estate, when cap rates go up, values go down. Cap rates track closely interest rates because the investors, even though the cap rate doesn't count debt, the investor does. They have to pay for it. So as interest rates move up, the cap rates move up. Risk increased in the market. That means investors were no longer willing to pay for CO deals. Now developers who used to be able to build that and then turn around and sell it at a really high value and not have to do any of the work, they couldn't sell it at CO. They actually had to fill those assets up. That takes years more. And so they're not getting their money. Their money's tied up. And now they have the risk. And as cap rates went up and values went down, their payday was getting less. That's bad. And so developers stopped developing because they were getting in trouble. But remember, that is years after the event started. What that means, we just started seeing the contraction in development in 2024 for a lot of industries. Office, it was before because their pain started to come before. But for most of the commercial real estate assets, 2024 is when we started to see significant changes. That means most of that contraction in development, or those lower development numbers of starts, product being put on the market, are likely to be seen in 25, 26, or maybe even 27. So the development collapse is just getting started. The second part is rising cap rates that I talked about earlier. What that means is values are going down. Now, if the intrinsic value is there making you good money, that may not matter as much. I call this a valuation trap, meaning that external valuation matters if you have to sell or refinance, because then they look at the value of that property on the market. If you don't have to do anything with the property, if you don't have to sell it, if you don't have to refinance it, then it can just sit and make money. But when you buy a property at a 5 cap at 3% interest rate, in 3 years you have to refinance that, and interest rates are now 8 and cap rates are not 5 anymore, they went up to 8. That equity you had is gone, just vanished, disappeared. The asset may be producing profit, but it doesn't matter because the value is down so much, the equity is gone. The bank has to readjust the loan, and you can't just sell it on the market because the market doesn't have buyers anymore. That's why it's a trap. This is how cash flowing properties go under. How big has that change been? Well, as you can see here in this chart, we have cap rate trends from 2018 to 24, which went from on average 4.5 to now over 6%. That's a 30% compression in many deals. Well, lots of deals in commercial real estate only put 30% down. In fact, large amounts of them put less than that. That means they're upside down or negative equity. Remember, small move in cap rates and even interest rates can make big moves in value. This leads us to the next problem. As interest rates went up, the market slowed down. The market of not buying and selling of commercial real estate, but the actual market of people using the real estate. That means there's less people moving, there's less people buying things, just transactions in the economy are slowing down. That means we didn't see as high of occupancy anymore. That means rental rates were dropping. So as the extrinsic value was going down, the intrinsic value was going down at the same time. That is even worse because intrinsic value, remember, is net income, and net income is a multiple that equals value. 100,000 at a 10 cap equals $1 million. 100,000 at a 5 cap equals $2 million. So if you have a 5 cap at $100,000, and that means $2 million, but you lose because of occupancy and rates, $50,000. That may seem a lot on net income, but on gross income, that may not be a huge amount. But your net income fell in half. $50,000, even if the property makes $500,000, means you lost half the value, or $1 million. So cap rates go up, income goes down, value evaporates. Even the best operators cannot protect themselves from this type of market downward trend, internal and external. There are things you can do to hedge against it. There are things you can do to protect yourself, like we have, which we will discuss. But overall, it doesn't mean you're protected from losses or even just pain. Now you're making less money or no money, which we have in several assets, as well as everyone else. But does it take you down? Do you actually go under from it? Those are totally different things. Largely in market cycles, the assets that are protected the most are the ones that have the highest barriers of entry. Think first-tier markets like Southern California or Manhattan. Why? Because there's just no more inventory, there's less competition. So market changes don't affect it as much because they basically have monopolies. Now, this leads us to the next outcome, which is transactions. This led to an absolute freeze in the transactions of commercial real estate. Overnight, it seemed it just shut down. Why? Because sellers viewed their property, when interest rates were 3% just the year prior, at being worth a 4 cap. But buyers have a new interest rate. So they say, I can only pay an 8 cap. That means buyers are asking the sellers to come down by 50%. Sellers are going, what are you talking about? My income hasn't even changed. And you're saying that it's worth half? I'm not selling. And buyers are saying, I'd love to buy you, but we can't afford it. The bid-ask spread, what buyers want versus what sellers are willing to do. That spread became huge quickly. How much? Well, in all of commercial real estate, we saw over 55% drop in transactions. And that was up to last year. Private capital and investors' capital are just sitting on the sidelines. Lenders are underwater on their existing deals that they have, so they're not writing anything new. They're not issuing new paper or loans, and especially to anything that seems risky at all. They're just pencils down, saying, hey, we're done. Now, you may be saying, well then AJ, why in the world haven't we seen defaults? And that's the question. Why hasn't commercial real estate seen more defaults? Now, we did see some, particularly in office. And office is going on a very long trend of struggling. Lots of fundamental value issues with office. Other real estate asset classes didn't have as many fundamental issues like multifamily or self-storage, as well as mobile home parks. It was mostly that extrinsic issues that were affecting those asset classes. But we didn't see huge defaults, and you would have thought in a scenario we would have, like we're seeing today. Why? Well, the government told banks to do what? Not put them into foreclosure, not create defaults. Kick the can down the road. The banks wanted this too. Why? They learned after 2008, if we take a property back, we don't know what to do with it, and it's going to lose even more money. So that's what happened. Banks started to kick the can down the road, which led us to 2025. Now, between 2025 and 2026, we have roughly $1.5 to $2 trillion in commercial real estate loans that are maturing. That's in the next 24 months. Many of those are going from 3% debt to 8%, meaning they can't even pay for the debt. They're running negative, and they're definitely underwater. This will create DSCR shock. What is DSCR? That is debt service coverage ratio. That means with the money you have, how much is that to pay the debt? So what is the ratio? How much money does the asset produce that allows it to cover debt? And what's that ratio? Above a certain point, they don't write. They don't loan against it. Meaning that if your debt coverage ratio gets to a point where they're looking at it and they're like, it's not enough for us to feel comfortable, they can't write it. They can't give out that loan. Also a big change since 2008, where after 2008, debt service coverage ratio became a standard for issuing loans. Interest rates going from 3 to 8% makes it almost impossible to meet those DSCR ratios that banks need to write that paper. They're underwater, and that means they're going to have to come to the table with capital to pay down that debt to get that back in line, if the investors are willing to. If not, the bank has to take it back. This is all exaggerated and made even worse by this key point. While occupancy was going down, rates were going down, cap rates were going up, there was something else happening in commercial real estate that has hurt us operators severely. That was insurance, taxes, and payroll have inflated dramatically over the last 3-4 years, i.e., our major expenses on property have gone up in lots of cases by double. That creates a position where not only are you not making more money, but even if your revenue stayed the same, you're making less net income. That hurts everything. That hurts your debt coverage ratio. That hurts your cash flow. That hurts your value. It's like getting hit on every single side. Overall demand within commercial real estate for the individual asset class has gone down, occupancies and rents. When demand goes down, those rents start to go down. So occupancy goes down, rents go down, that hits revenue big time. On the external side, on the valuation, cap rates are going up, there's less buyers, values are going down. And then on the expense side, as revenue's going down, expenses are going up. It has been a tough few years to be in commercial real estate. Trust me, I know. But it's okay. Why? Because the great and glorious Fed will come down from on high and save us. I don't think so. And here's why. The Fed is stuck in a really tough spot right now. The economy's growing. And you may say, but we just had a report that said the economy shrunk. Well, we had a GDP of 0.3 negative, but that was largely simply due because of trade. And what happened is trade was front-loaded. So you had a big gap. Now, that gap created a massive deficit. Outside that, when you looked at the GDP, our economy grew. So take out that deficit on trade, economy grew. We had huge amounts we had big increases in things like employment over the last 3 months. Consumer spending and things have slowed down, yes, but not gone negative at all. In fact, they're still moving forward. And the Fed just came out yesterday and said the economy is resilient, it's still growing. We can't lower rates. Why can't they lower rates? Because of that nasty little thing called inflation. Remember, money is debt. Inflation is simply caused by too much money in the system. As the money supply grows, you have more dollars chasing goods and services. That causes the price of goods and services to skyrocket. This is what caused inflation. The government printed money at trillions upon trillions and trillions of dollars, pumped it into the economy for COVID and well after COVID, all the way up to 2024. That mass printing of $4+ trillion a year on top of COVID in an economy that was growing exploded the money supply and caused runaway inflation. How do you get inflation to stop? Interest rates go up. Why? Because debt is money. And so if nobody can have debt, the money supply should shrink and go down. But the moment you lower interest rates, it's like leverage on all the money that's there. And the economy isn't losing that money. The money supply has actually gone up. So it is not gone down. Leverage on the current money supply would cause inflation. The Fed feels like they're backed into a corner and stuck. Normally, when you lower interest rates, it's because the money supply is shrinking. As in, we have defaults. You have people losing their jobs. People are getting less income. They're losing their houses. Consumers stop spending completely, and that money supply starts to shrink because it's evaporating. That's what happens when you have defaults. The money goes away. The money supply shrinks, and you start to get something called deflation. Lower interest rates increases the money supply, stops deflation. We don't have deflation, and we don't have a shrinking money supply. So now you're saying, great, AJ, you just basically told me I have a complete apocalypse. On every single point here, it's bad. Well, not entirely, and here's why. You see, the first point that I brought up, remember that development cycle? Now, it takes a long time for that development cycle to stop, but we already saw it starting to stop in 2024. In fact, it took a really big hit, remember? That big contraction in development has another effect. It limits supply. And when you limit supply, even though there's less demand, there's less supply, that means for the owners and operators, demand goes up. This is what we saw after 2008. After a real estate crisis, development stopped. Demand surged. With demand, high occupancies and rents went up, and away. That is the benefit of tough market cycles. It actually makes it healthier in the long run. The problem is markets had built to levels during COVID that were unreasonable, that were never even true numbers. They were just government funded. And everything was over-exaggerated with government funds and zero interest rates, free money. Everything was so overpropped up, and developers built to that. So that's taken time now. But what it does mean is operators that own and will survive are on the other side. Now, where's the bottom? And should you wait? No, you shouldn't. What do you do now? Well, we learned this in 2008. During that crisis, we'd stopped buying right before 2008 because deals didn't make sense. We didn't know that there was going to be a real estate crisis, but we didn't buy. We got out of debt. After the real estate crisis, we started buying again. The same thing has happened to us through different cycles. Does it mean we didn't feel pain in 2008? No, we absolutely did. Everyone did. In fact, when we were buying in 2009 and 10, the extrinsic value on our properties the year after we bought it had probably gone down. But we didn't care because the intrinsic value was there. And when it came back, we made tons of money. Here's the thing. How do you know when to buy and sell? You don't try to time markets. Instead, you let your money time markets. How do you do that? You have a buy box. I knew what my buy box was. The buy box is the metrics that I need to meet to purchase an asset, what it works for me. For us, we have our underwriting that tells us I need to see X return, I want a value add property in X city. When it meets that buy box, I can buy it. Now, that buy box, usually when you're at the top of markets, you can't buy anything because those returns aren't there. When prices go down, the returns intrinsically go up because the returns off the purchase price to what you make. So then we end up buying more. That's what we're seeing today. This year, we're buying. We haven't bought for like 3 years. In the first quarter, we've already bought more deals than we bought in the last 2 years. Now, you may say, okay, AJ, but you're saying it's not the bottom yet. Does that mean that prices will go down more? Yeah, I kind of think that they will, especially through this year. That just means I'm going to buy more. That's all, because my returns will just get better. Then when we go back, everything that we've bought will look like it was so cheap and no one will even remember the difference of 12 months on a cap rate that moved up or down a little. Look at it as a business, what it produces and what you get when you buy it. Then, to avoid the extrinsic side, don't get yourself in value traps. Meaning, I don't know what the market is going to do in the short term, so I have to protect myself against it. We take our debt limits out to 10 years until we have to refi. We don't want to have to sell in any of those years during that 10. If there's an opportunity because somebody's going to pay us a stupid price, great. We just don't want to have to sell. So that way, if extrinsic prices go up or down, we don't really care. As long as the intrinsic is good and going up, when the markets stabilize from being crazy, we're actually way on top. That exaggerates our returns through market cycles and can protect us. But it has been rough over the last 3 years. The reason why is when these things happen, unexpected things happen in the market. Certain areas get hit harder than others, and you don't really know necessarily until that happens. The other problem that happened is even though the market cycle had changed, we had people that developed close to us even as market cycles were going down, therefore exasperating that local area. And it hurt. Some of those assets we're just gonna have to sell off and reposition capital within our funds, but we're buying at bases so much lower we can do that. That's what we're starting to see a lot of right now. You have large operators like us and others, and then you have institutional and the big boys that are reshuffling. They're moving capital around. They want to be able to take advantage of the opportunity. And they're now realizing some that won't do that great. So they're moving their money around and buying others. But even without moving money around, we have been raising a lot because we're trying to buy a lot. This is very similar to what we saw back in 2009 through 15. And we see that end of that cycle, and so we're trying to take advantage of it and protect ourselves again from short-term further market fluctuations. If you'd like to know more about our investment thesis and strategy and how over time we've been able to produce great returns, then make sure you guys subscribe and follow this channel.